Hey guys, it's Justin Goodbread with Financially Simple. So we're doing something new today. The team at Financially Simple has said, Justin, we need to be able to ask you questions. So they have challenged me to work on a Friday afternoon after I'm brain dead from a whole week, guys. Been pouring out knowledge all week, been working with the team, been working with clients. I'm in the middle of getting prepared for as an expert witness in a lawsuit. Well, not a lawsuit. It's in a court hearing. I'm an expert witness in that. I've been pouring over that this week, and they said, Justin, we need you every Friday to make yourself available so that folks can ask you questions. So here we are. It is Friday on August the 3rd, 2018. And we are going to deal with a Friday Q&A. Now, I originally said that they want me to do it for an hour. Now, I don't know if we're going to go for an hour or not, but this is a chance for you for every Friday. If you want to shoot a question during the week, you can drop it at Financially Simple on the Facebook page, Financially Simple. Just drop me a line there. Hey, Justin, answer this question. If you want to email me, you can email me, Justin at financiallysimple.com. If you want to shoot me something through Twitter, I'm there. LinkedIn, I'm there. Wherever you want to drop a question at, we're going to try our best to answer those questions. So this is an opportunity for you to ask a certified financial planner. I feel a little humbled saying this, one of the top 100 financial advisors in the country, according to Investopedia. I'm just amazed at that particular accolade. I guess all the efforts that we've been dealing with is come to fruition. Our team is rock stars behind the scenes, but they thought it's a good idea. So I get questions all the time. And now if you have a question, feel free to drop a line there. But one of the questions I was dealing with just this week in the office was this. They said, Justin, I'm a business owner. What is the fastest way for me to accelerate the growth of my business? What's the fastest way for me to accelerate the growth of my business? Man, that's a good question. And I had to take some time, and I can't get into too much because of client confidentiality issues, but the question is valid nonetheless. And in this particular question, I'm dealing with the eight core areas. So think about a pie, a pizza pie, that sliced up pizza. Oh, guys, it's Friday afternoon. Time out. I might have to stop and get a pizza tonight. Just saying. But think about a pizza pie. And there's 8 slices. Man, I'm not going to make it through this if I keep talking about pizza. Anyways, there's 8 slices of the pie. This particular person is a very analytical person. This particular person owns a service type industry. And in their intellect, with an analytical person, they often want to see the results before they make action. Not uncommon, very common approach. And this particular person, I said, in opposite of your brain, the way it works, I really need you to market. He's like, man, market's a waste of money. I actually told this to like 3 people this week. 2 of the people said, yeah, man, I got you. One person said, Justin, marketing is a waste of money. I read a study not too long ago that we should spend about 10 to 20% of our gross revenue of our companies in marketing. That's about the number we should spend. And this particular person wasn't spending anything, like 0, which, okay, they're somewhat successful. But I said, the fastest way for you to grow your company is to pour more dollars into marketing. So we're talking 10%. I was reading a study not too long ago that some of the key players, like Apple spent like $1.something billion, $1.6 billion. I don't know if you know, I don't know if you noticed it this week, but Apple is the first company in the history of the world to break a trillion dollar value. That's mind blowing. But this company, this company which reached that status spent $1.6 billion in marketing. So if you want to grow your company, one of the best ways to grow the company is through marketing. And so many people just, because as business owners, we want things to be super quantified. And so many times we just don't spend money on marketing, and we should. So that answered that question. So now's your chance. In the message section over here, drop me a line. I've got a message here. Angie's asking, which method do you use to calculate a company's assets invested in an external project? Which method do you use to calculate company's assets invested in external projects? Well, Angie, I think I know what you're asking. That's the wording's a little off. So let me see if I can hit this. If I do, just shoot me a message and say, yeah, Justin, you nailed it. Oftentimes we'll run a calculation with business owners and they'll say, hey, Justin, I'm trying to make a decision. I'm trying to make a decision if I should market with these dollars, if I should purchase a piece of equipment with these dollars, if I should perhaps buy another business or buy an asset somewhere with these dollars. So there's a number of different ways we can allocate monies toward certain ideas that a business owner will have. Well, if we just throw the ideas out there, but we don't quantify that information back, I think I'm answering your question there, Angie. If we throw the ideas out there, but we don't quantify it, then, there's really not a way that we can say that buying an asset or buying a business or investing in a piece of real estate or investing in marketing, ultimately we're trying to decide which one of these choices are, and you said investing in external projects, but ultimately it's going to be, where do we put our money at? So there's a calculation that we run in the financial world called a hurdle rate. A hurdle rate. So think about the guy running down the track in track and field, and you're hurdling over what I guess they're called hurdles. Things, I don't know, guys, forgive me, but I often kind of chuckle because my little short legs can't jump that high, but really tall people jump that high and they hit it and they fall over. I'm sorry, I've laughed a couple of times. I think they're hurdles. I could never jump that high. I mean, this short fat kid can only jump like this high. Sorry. But anyways, it's called a hurdle rate. So we can actually calculate through mathematical equations what the company's return on investment has to be before we ever deploy money toward marketing, toward asset purchases, as you said, Angie, toward investing in external projects. We have a lot of different ways that we can calculate which way those dollars flow. And it's called, the calculation method is called a hurdle rate. I think, Angie, that's what you're asking. Shoot me a message. Let me know if I answer that question. If you want to know how to calculate a hurdle rate, I'm going to tell you to go to the blog, Financially Simple. I actually am dealing with that on the podcast. Financiallysimple.com is the blog. You can go to the podcast on iTunes, Stitcher, Spotify. It's everywhere. And I believe probably episode number 76 or 77, I deal specifically with the calculation of hurdle rate. So take a look at it and see if that's something that would answer that question for you. All right, so that's number one. Let's see. Dunn here asks, what is your investment philosophy? Ew, that's a fun question. My personal investment philosophy. I want to make money. If I'm investing in something, I want to make money. So I'm a business owner. I work with a ton of business owners. I work with a ton of people going to who are just trying to retire, who are working as an employee somewhere. To me, I believe God gives us resources that we can use for his glory. You're asking my philosophy. I believe that God, everything we have, God gives us. That's my personal belief. And I believe that in those assets that we receive, we ought to invest those at the best way that we know how to do it. So in my world, best is not a good word, so I'm going to pull that one back, but we have to invest the dollars to our own personal connotation. So I personally invest a lot of my time in my business and in my family. Those are my two biggest investments. My largest investment to date is my family. Miss Emily stays at home. In fact, someone asked me not too long ago, a client said, Justin, I'd like to see your personal net worth. You've seen mine. I said, that's fine. I'll show you my net worth. And first of all, he was surprised at the net worth. And then he was also surprised at the net worth for two different reasons. And he said, Justin, I was expecting this position to be a lot lower, and I was expecting this position to be a lot higher. And I said, well, it is what it is. And I said, but one thing that's not shown up on my personal financial statement is the fact that my wife and I have chosen in our personal life for Emily to stay at home with our kids. Emily's college educated. She's super smart. I mean, she deals with my brain and it's crazy. And she's the one who sets me straight. So Emily's super smart. She goes in and she says, Justin, or we say, we're going to invest our money into our family first. So part of our investment philosophy is, it's not the idea of getting all we can, canning all we get, and sitting on our can. That's an old saying that we heard in the South a lot. Instead, we ought to take the dollars God gives us and utilize it for the things which reap the maximum reward today. That's number one. So we invest in our children now versus putting money back in college accounts. I invest very passively in the stock market, if you want to use that term. I invest very broad. I believe, and I can prove this analytically, mathematically, I can prove it a number of different ways. I believe that for the majority of business owners, in my opinion, business owners, and for the majority of people who are trying to reach their personal goals, that a well-diversified portfolio, including multiple asset classes, will yield the results that most people need. I'm not telling you how to diversify because that's up to you and your personal advisor. But a well-diversified portfolio investing in multiple asset class will yield us the diversification we need. Whenever you invest, it's all about which risk can you deal with. So if we say, you know what, I can't handle the stock market risk, but I can handle CDs. Well, you run into a risk there of potential inflation risk where the price of goods and services increase over time. You say, Justin, I want to make more money than CDs or than cash, but I don't want to go in the stock market. So then there's all sorts of little points in that paradigm of investing. You may say, well, I want to buy bonds. I have a lot of retirees who want to put a lot of money in bonds, and that's okay. But one of the risks they have is interest rate risk. Right now, the Federal Reserve has raised rates 2 times this year. A week and a half ago, I think it was, maybe even last week. My dates are running together. Anyways, Federal Reserve came out and said, we're going to raise rates 2 more times. I think it might have been this week they came out and said that. Well, every time the interest rates move up, the pricing of bonds go down. That's a risk. And so if you're investing in bonds right now, especially long-term, like 30-year bonds, then man, you have some risk that your bonds could drop in value. I'm looking around here for something. I don't see it on my desk in front of me, but let's pretend we're on a seesaw, okay? And you know the seesaw, whenever we were growing up, one person would go up and the other person would go down, and they would teeter back and forth, right? So in the investment world, everything has a risk. Like, let's take about bonds, for example. If interest rates go up on this side over here, if interest rates go up, the bond price starts to drop down in pricing. That's a risk. So some people say, well, I can manage that risk. Oh, really? So if interest rates move up 1% on a 30-year bond, you can end up losing 7% in account value over here. Oh, I didn't realize that. So to me, investment philosophy is all about making sure we're diversifying our portfolio as much as possible so that we can meet our personal objectives. Now, to me, as a business owner, I invest a ton of money in my family. I invest money in my business, but not all of it. I don't want a lot of money going in my business. But I do want to invest in such a way that anything I have in the stock market is super simple. I don't want to have to think about all the stuff moving around. I also buy rental property. I do. In fact, I'm selling my last rental property right now. I have personal reasons for that. I'm not telling you that's advice that you should be selling property right now. But I believe you ought to invest in multiple different asset classes. Asset classes are not just stocks and bonds. You could have commodities. You could have real estate. You could have precious metals. You could have oil, natural gas. We ought to invest in such a way. Ultimately, though, the key of my philosophy is that however I invest, I have to be able to stand before God Almighty with and say that I took the knowledge I have, the skills I have, and the input from advisors, from whoever else I have, to the best I could to maximize His glory. So that's my investment philosophy. That's me. I'm not saying it's yours. We manage tons of money here, and I have lots of clients who don't agree with my investment philosophy. So, and that brings up a question that I'm asking is, well, Justin, if you don't agree, if your investment philosophy and your client's investment philosophy are different, what do you do? My job is to act as a fiduciary. My job is to take the knowledge that I've been trained with and the foresight and everything that I have and all the content that I deal with in my world, all the reading and studying, and tell clients what options they have for their benefit. It's hard to say their best interest because no one ever knows the best. But my job as a fiduciary is to go in and tell the clients with the information I have and all the quantification I can do, here is the approach you should take, and here's why, to the best of my ability. That's my job as a fiduciary. So I can't let my personal biases get in the way of that. No way possible. So I hope I answered your question there. That's the way I think. That's my investment philosophy. All right, we have another one here. Flooding Love, you ask, you owned and sold a landscape business in the past. This is correct. I did. I owned a business. My brother and I started a business when I was 15. And that ultimately, we went to college, came back. I started a business, brought a partner in with me, and ultimately sold that business. So for those of you who didn't know that, that's the very first business I sold. Since then, I've sold 3 businesses, but that was the first one I sold. And it says, if you said no on the day you sold it, could you implement strategies, knowing what you know today, for 5 years that could double what you were? Oh, yeah. Okay, so that's a good question. That's a good question. I'm actually dealing with that with multiple companies right now, multiple businesses. So at some point in our career as business owners, at some point, if you're working for a business owner, at some point, the business is the people who own it are going to change. It's going to happen. At some point, even my companies today, Heritage Investors, most of you know I own a company called Heritage Investors. It's a comprehensive wealth management firm located here in Knoxville, Tennessee. I own that company. I own Financially Simple. We're getting ready to release a book. Man, I can't wait. I'm like this close to releasing our first book. And it's actually dealing with this a little bit here. So if I knew then what I know now, could I have taken that company and doubled it? Dude, let me tell you, I probably could have gone 5X, 10X on that company, and not in like 3 years. Forget 5 years. I could have probably gone 10X on that company. Yeah, so to answer your question, could I double it for what I originally sold? Dude, I'm telling you, I probably could have gone 10X on it within 5 years. So what do you do? So every one of us who own a company, or if you work for a company, this is what happens. The company is valued at something. Now, it may just be the cash in the bank, but there's a value to it, okay? And whenever we have this company that we are growing, we're ultimately trying to figure out as business owners, number one, how can we increase our income from the said company? So we have an asset here. How do we get more income out of the asset? That's what we're after, number one. Number two, though, is can we grow the asset higher? So over a period of time, so over a long period of time, how can we grow the asset to where the asset is transferable or sellable? The way you do that is called value growth. It's interesting. I just earned a certificate or credential earlier this year called Certified Value Growth Advisor. And that's the whole idea on all the different ways you can take a company and go from here to here. So yeah, to answer your question, I know who this is now that I'm putting it. I was like, who is Flooding Love? I know who you are. Yeah, if I know what I know, man, that company could have been a rock star. And I'm not saying it was a bad thing, but it was good. So like that. All right, let's see. I think I answered your question there. Flooding Love. Uh-oh, I got a happy face and smiley face. Oh, made somebody mad. Sorry about that. What is a fiduciary? Okay, a fiduciary is a person who has to take the knowledge they have in their head and act as if they're the individual and act in the individual's best interest versus what's called a suitable individual. So in the financial world, I think that's where this question is coming from. I didn't expect you to ask this question, but where this question comes from is this. In the financial worlds, there was a big rule called the Department of Labor law that got killed like a month ago, just done. It originally started with President Obama's administration, And it said that financial advisors who dealt with retirement accounts had to act in the best interest of the client. That's a fiduciary. Many people were surprised that financial people, even today, the majority of people don't have to act in the best interest of a client. They have to be suitable. They have to provide suitable recommendations. The way I describe it in my financially simple terms is this. Let's say I'm at a store that sells coffee cups, and you say, Justin, I need a coffee cup. I said, great, you need a coffee cup. Cool. I got a glass mug here. I've got a styrofoam mug here. I've got a travel cup here made by Yeti. And I just give you a list of coffee cups, and you go, I really like that coffee cup. Okay, well, here's a coffee cup. So that's a suitable recommendation. That is, but you said you want a coffee cup. I showed you a suite of coffee cups, and you picked the one you like. That's suitability. But how do you know that coffee cup is exactly what you need? What if you're going to take this coffee cup hiking up in the mountains? Well, you need a coffee cup that actually holds the coffee that keeps it from leaking. You can't use a mug. So a fiduciary, instead of coming in and saying, hey, I need a coffee cup, a fiduciary is going, okay, what are you going to do with this coffee cup? Really? Oh, you're going to go hiking. Okay, do you want the liquid inside the coffee cup to stay warm? Do you want to be cold? Yeah, you want to stay warm. Okay. Hey, we got bears in the East Tennessee here. You don't want a black bear chasing you down. Do you want this thing to stay super sealed tight and also keep the liquid warm? Oh yeah, you don't want it leaking. Okay. All right. How much content are you going to have in this coffee cup? Oh, you need like this much content. Oh, okay. Well, let me show you now. Based on all that information, here's the cup you should buy. That's the difference. So in the financial world, so many times people come in, they say, I need a product. Well, here's a product. Versus letting a fiduciary look holistically, looking at taxes and investments and insurance and planning goals and all these different things together to give you specifically what you need. So that's the difference there. I hope I answered that question for you. Alicia, my friend, how are you? Let's see. If someone has never invested and wants to get started somewhere, what would you advise as baby steps to get started? That is a great question. Tell Jimmy I said hello, by the way. So let's go back to some foundational things. Before we can answer this question, I have to make a couple of assumptions. And I know we could probably chat about this, but let me give you some basic assumptions. The first thing is, before we start investing, we want to make sure that we have, number one, our emergency fund set back. Okay. You've heard topics out there. I was listening to Clark Howard. He's one of the guys who I actually like to listen to, one of the talking heads, not a financial guy, but I love how passionate, how gentle he is. I like to listen to him. He was talking about the importance of an emergency fund. In the CFP boards, we are required to tell clients that you need to have an emergency fund in place. So an emergency fund can be as little as $1,000 for some folk. It can be 6 months worth of expenses. It can be 3 months. Every case varies, but you need to have an emergency fund. So let's assume that's the case first. Okay. So if we have an emergency fund, number one, then we go to, are there any crazy debts that we need to knock out of the way first? So the crazy debt to me is credit card debt. We got to get out of the way before we start investing. You got to make sure if we have any car debt that the car, we can actually sell it for what we owe on it. Okay. Some other talking heads will say liquidate everything. Math just doesn't work that way for me as a fiduciary. So you got to make sure you've got an emergency fund. You got your crazy debts out of the way. Some people call them stupid debts. I call them crazy debts. So we got to get those out of the way. Then once we have that going, the best way, the baby step is start small, not by necessarily dollar figure, but start small in the thinking. So you want to start off with doing a concept called dollar cost averaging. And what that means is you're going to take a little bit of money every month and you're going to put it into one or two very basic investments. So I would personally start off, if it were me, with a good index fund, a good growth index fund, or a good low-cost ETF, or what's called exchange-traded funds. Now, Alicia, I can't tell you specifically which ones I would use. I can't do that because I'm a fiduciary and I can't give advice over the air. But I would start off with a very good index fund or a very good ETF. And you can talk to your financial advisor about that. But I would start with something very small, something very low cost. man, fees can hit us. It's actually the third reason for us losing money. The first one is allocation. The second one is taxes. The third one is fees and investment. So I would start off with a very, very simple fund, and then start off by putting money into it every month. So we've got our budget in place, and we're just going to start making slow contributions, okay? And if you say, Justin, I want to get the hang of this, I want to deposit $25 a month, I want to deposit $200 a month, I want to deposit $1,000 a month, whatever the number is, start somewhere, but start very basic, putting money into one location every month. Now, I would personally use the account type that I would use if you're eligible is a Roth IRA. I like a Roth IRA for the majority of folk out there. Now, sometimes business owners, we have to do things differently. Sometimes we may need to use a Roth. Sometimes we may use a 401k or something like that. But I like the idea of using a Roth IRA to buy consistently small amounts of money, doing dollar cost averaging into that investment on a monthly basis, weekly basis, bi-weekly basis. I'm going to go one step further, Alicia. I use personally, I'll tell you I use this. I have a company that I bought that I use called Acorns on my phone. It's an app. And what it does is it automatically rounds up every purchase. So when I go to the gas station, I get $35.01 of gas. That app is going to automatically pull out 99 cents out of my account and put it over here into an investment account. Very basic, just into an investment account, and it'll do its thing. And I think I'm already at, like, here we are in July. I think we've saved like $1,000 or $1,200 just with little dollars pulling out of the various accounts. And so we're going to use that for mine and Emily. We want to do a big trip in 2 years whenever we hit in 3 years when we hit our 20th anniversary. So we're saving money out slowly. So there's some apps out there like Acorn, like Stash, that you can use to start basic with. So to me, I would say use a Roth IRA. That's very basic. Use a good ETF or a good index fund. Those are very basic. I would go in that avenue. That's the way I would go. So I hope that answers your question, Alicia. If it does, just give me a thumbs up. Hey, do me a favor, Alicia, share this with somebody. Maybe I can help somebody else. All right, we got a question here. My small business is growing, but in the last few months, growth has become stagnant. How can I remedy this and begin moving forward again? Oh, that's a complicated question. I would have to figure out why the company is stagnant. The economy's booming right now. So you could be in a business. I have a client who's actually facing this right now. They're in a business which is correlated negatively to the economic market. So when the market is doing really good, their business suffers. But when the market is doing poorly, their business is like gangbusters. So if you're in a business like this, we could explain it, and then we could build a model or a strategy to help your business grow over the next period of time, whatever that may be, 12 months. Now, if you're not in a negative correlated business, one that should be accurately matching the market, in other words, the market's way up, you should be booming right now, then we have to look at the bigger issues. Are you overspending? Is your sales process not properly in place? How's your marketing? Marketing's a big one for me, guys. So many people don't market. I read a story one time. I heard this story about a hot dog vendor who had a hot dog cart running through a major off ramp up in Jersey, and it had a big old sign. I don't remember the name. I'm gonna call it Pete's Hot Dog Stand, best hot dogs in Jersey. And every day, man, he was serving people hot dogs. I mean, he might even had the West Virginia dog, where they put the chili on there and the coleslaw and mustard. Oh man, I'm getting hungry, folks. Anyways, he might have had this type of hot dog, and he had a big line. And all of a sudden, someone says, "Dude, don't you know there's a recession?" He's like, "No, I didn't realize that." And he said, "Oh yeah, you better begin squirreling away money." So the very first thing he did was cut his marketing. And when he cut his marketing, downturn. No one knew about Pete's Hot Dog underneath the interstate anymore because the sign was removed, and now Pete's out of business. Real story. So many times whenever businesses become stagnant, that can create problems. That could be the marketing. If it's not the marketing really good, it could be the sales funnel. You don't have your sales process in place properly. That could be the issue there. All right, Pierre, what about mutual funds? Okay, I'm not exactly sure of the question. What about mutual funds? So let me see if I can figure out the context of that. What are my opinions on mutual funds? Let's do it this way. There is a talking head on the radio who says to only buy growth stock mutual funds. Only buy these things. Okay. I disagree. Be candid about that. There's too much studies out there which says that if we're using actively traded funds versus passively traded funds, so that's maybe what you're asking about, Pierre. An actively traded fund is where we hire a money manager to actually look at our investments and to say, the easiest way I can give it actively traded is you got the S&P 500. That's the most popular index out there. Now, remember, an index is unmanaged. You can't buy an index, but it's out there just as a benchmark, okay? So the S&P 500 index, this unmanaged group of funds, if we're hiring an actively traded mutual fund, that fund manager is trying to look at those 500 investments, and they're trying to say, out of these 500 investments, we think these 100 are going to be the best to give us the best return. So they buy 100 out of the 500. That's an actively traded fund. A passive fund, which is often referred to as an index fund, is where the fund manager of the mutual fund buys the holdings of the index, whatever index it may be, and tries to mirror the index. Sometimes beat the index, sometimes not, but they try to mirror the index. So that's a passive versus active. I believe both of these have their place in a portfolio. I'm not against mutual funds. I believe they're needed. Studies have proven, and these are on our website somewhere on financiallysimple.com. If you go there and look at the blog, guys, there's so much content on there that we've written. All these studies that I read because I have no life. I usually get the team to write a blog post about it. We make sure and we put it out there. But there's a study that was written that says in the large cap world, so the S&P 500, the Russell 1000, that's the large cap index. You got the growth and the value, so two different types there. In the large cap world, active managers very rarely beat the index. Very rarely. I can't remember the exact statistics. I think it's like 8% of the time, maybe 12% of the time they only beat it. So like an 80% failure rate when you're using these active managers for these large growth companies. So because of that, many times people will say, well, just buy an index. Just buy an index out there, an index investment. That's true. It does work on that large growth section. But in the same study, whenever you get out of the big companies and now you're going in and buying sectors, somewhere like maybe gold or somewhere like materials or even bonds, there's many studies which show that actively traded mutual funds in the bond and in particular sectors actually can yield or historically have. Now we do know, I got to say this for compliance reasons, we do know that past performance is not indicative of future results. We do know just because what happened in the past doesn't mean it's going to happen in the future. But the history shows us that in some areas that an actively traded fund does work. So in my practice, we use actively traded mutual funds, passive mutual funds, actively traded exchange traded funds, close-end funds. The thing we try to stay away from is individual stocks. So Pierre, I hope that answered the question there on that. You said ETF and index, so I was wondering about a mutual fund. Yeah, okay. So I think I answered that question there for you. Thanks for clarifying that. So yeah, I like exchange traded funds. I like them. They can be both kind of passively managed or actively managed. So I like those. I'll use them when I build custom portfolios. I like index funds, and I also like actively traded funds. All of them have their place. One is not better than the other. There's too much research out there which says the more that we can diversify that portfolio for the client's specific risk, the better chance, I wouldn't say the better chance we have for that client not acting emotionally through the downturn of the market. So yeah, so thanks for clarifying that, Pierre. I like them all, man. I like them. I think there's a time and place for everything. What I have a hard time with, candidly speaking, are as individual stocks. So many, thank you, Pierre. Thanks for making sure I got that for you. So many people want to jump on the best, hottest stock. And for the vast majority of folk out there, it's hard to diversify the risk away with individual stocks. There's some studies which have been done that shows that by using indexing or by building a diversified indexing style portfolio, you can actually create a little bit better, more stable growth. The issue is not the actual holdings many times. I mean, we can build some stellar portfolios for folks, But if the clients during the downturn don't listen to the advisors, man, I lived through 07, 08, 09. It was hard. I mean, we saw advisors jumping out of windows. I saw people having a tough time. And whenever that market dips down, it doesn't matter if it's an ETF, mutual fund, passive, active, the emotions that we investors go through can be devastating. Now, coincidentally, if you're buying a hard asset like a piece of real estate or of a piece of business and it goes down, then you're kind of handcuffed. So you're forcing yourself to ride through the trough, through the ups and downs. Whenever we're dealing with the securities market to where we can buy stuff that are what's called liquid, then many times our emotions are killing us. So the financial advisor, in that case, the financial advisor is trying to build a portfolio that'll protect oftentimes the client from the client, where at the same time give the client the needed return they need, not want. Guys, oftentimes though, it's not the return, it's our savings. Friends, we just don't save enough money. We don't. So guys, my voice is about shot. We're going a little bit farther than I should. I told the guys I'd be off here about 5 o'clock or so. We're about 6 minutes over. So, hey, thanks for being a part of this today. I'm going to shut this one off today. We're going to do it again next Friday. Hopefully my voice isn't wearing out like it is now. I've been talking a lot this week. Been in a lot of meetings. If this is helpful for you, do me a favor, share this out. Take a look at the Financially Simple podcast. The podcast, guys, in fact, I recorded a couple episodes today. I've got 15, 20 minutes. If you're a business owner, you cannot miss this content. This content can drive your business value way up if you just listen to it. If you're like, Justin, dude, this is just rushing to me. I don't understand it. Give our office a call. We can help you. If you don't have a financial advisor, reach out to us. Phone number of the office is 865-690-1155. You can reach out to Justin at financiallysimple.com. We can help you. Matter of, like I say every week, guys, life is hard. Life is hard. Life is good, though. We serve a mighty God. We do. Life is good. And money can be frustrating. Guys, let's continue to make our life at least financially simple. Hey, y'all go out and make it a good day. Enjoy your weekend. Take care. Bye-bye.